should we expect any move from you to link either your asset or your liability or both to external benchmarks? Okay, Shyam, I think we'll reconnect. Mr. Mohapatra, similar question to you. Should we see any product, or have you already planned any linking of your savings rate, your term deposits or your loans to external benchmarks?
Good morning, Lata. As I have gone in the public domain and said that effective from September, we will have some products which will be linked to repo rate. And we are going to the board to get the approval for this. And we will do it effective from September. I'm not basically giving the date when in September, but definitely in September, two products on the asset side will be linked to the repo rate. And as of now, linking the liability side with the repo, we have not taken a call.
Okay, Mr. Mohapatra, good morning. So once you do link the bank rate to repo rates, A, what percentage of your book would be linked, and B, do you see any impact on deposit growth itself? I mean, are you looking at a slowdown there?
In our bank, so far the slowdown I have not seen, and there is a pickup in the CASA deposits in our bank. Term deposits are also faring well. Now the question here is how and what percentage. Since the board has not approved it, I'm not in a position to give you what will be the percentage which will be of the total book which will be impacted by linking it to the repo.
Okay. Why are you not linking any of the deposit rates? Is it that you are still in deposit growth mode and so you don't want to lower it?
No, it is not exactly that. Since we are in the deposit growth mode, we don't want to link it to the repo. But what I see that since the CASA franchise is good enough in our bank, so there is still room where we can absorb without linking the liability side with the repo. But we will review the position as things pan out in future. But as of now, we have done our calculation, and we don't feel that there will be major impact on the NIM if I don't link the liability side with the repo, and I am linking, say, two products on the retail side with the repo.
Okay. Shyam Srinivasan is with us now. Sorry, Shyam, for that to and fro. I wanted to ask you whether you will be able to link any of your liability products, any of your deposit products. Mr. Mohapatra says he's not still looking at deposit products to be linked to repo. What about you? Do you fear that any cut in rates can actually lower the amount of deposit growth?
Firstly, Lata, I think my voice didn't come through earlier. We launched the external benchmark linked lending on asset products 2 years back. Today, 20% of our book is linked to EBM.
Both sides?
Part of the retail and part of the corporate on the asset side. And that is continuing, and I think in the year ahead, you may see that percentage only increasing, because that's a trajectory and a trend that we've established, and it's helping us. On the liability side, I have to be honest, it's not been the market practice, and now that one of the largest banks in the country has set the tone for that, we are actively evaluating. Very soon we will come up with the savings product linked to EBM. There is some sensitivity in terms of being the only few banks that do it. Once it becomes market practice, then it becomes very transparent, and I think that becomes the new standard. But now that the largest bank in the country has done that, we are almost ready to follow suit anytime now.
So do you see any slowdown as far as deposit growth is concerned? I mean, you know, once this happens across the industry?
See, I think deposits slow down if that's the pricing structure across banks. Then the slowdown is not because of a pricing strategy, it's more because of the market events, whether there is money supply, whether there is economic activity. So I would not comment whether the change to EBM linked pricing for deposits will automatically reduce or shrink the deposit growth, unlikely. That said, you may have observed my Q1 deposit growths were almost equal to our credit growth, which is about 18-19%. And I see the same trajectory. In fact, for us, Q2 would look a little better only because the rupee is weaker, and typically the NR remittances tend to be very strong during that period. So I think between external events, pricing strategy change, the general mood of the sentiments of the country, deposit growth is going to be dependent not on the whether it's linked to EBM or just a normal pricing structure. It's just a bunch of other factors. For us, I think we will match our credit growth in Q2 alongside deposit growth also.
Okay. Well, this is a little strange. Why are all of you hesitant to link the deposit rate to external benchmarks? You know, how is the MCLR derived? First you look at your cost and then you derive your MCLR. All of you are ready to link your lending rate, but you know, want freedom on the deposit rate. I mean, basically, why is there a hesitation? And secondly, generally, how are deposits doing?
I think your question is good, Lata, but the consumer has choice between bank deposits versus other products available in the market. So if the pricing is way off, then there's naturally a gravitation to other segments where money can move. That said, that's why I said once it becomes market practice or the leading players offer it, then certainly that will become the market standard. To the other part of your question, how is deposit growth? Like I mentioned, it could be very specific to our bank. Q2 momentum was much stronger than Q1 was, partly helped by the fact that the non-resident remittances have been very strong and will probably continue to be where the rupee is. But at an industry level, current account growth, which is hugely linked to money supply and the sort of lubrication of the system, I think that will take time to come.
Okay, Mr. Mohapatra, I wanted to talk a little bit about the business itself. This time you reported profits for the first time in many quarters because of a sharp decline in credit costs. What will Q2 and Q3 look like?
We will be able to maintain this momentum in the coming quarters, including Q2. But one thing is that in the Q1, major part of the profit, of course, came from the investment book. But since the stress level is coming down and the credit cost is coming down, so we will also get more of the profitability from our loan book also. So that is a positive directional change in our bank. And I'm quite hopeful that whatever we did in Q1, in the remaining quarters in this financial year, we will be able to maintain that momentum.
Okay. Shyam, what is the impact of all the slowdown talk on asset quality? Has it begun to hurt retail as well? Because, I mean, HDFC Bank gave us a warning about unsecured retail loans. And even last time in your slippages, retail had a higher share.
No, for us, I think if you recall in our results, post-results, I had guided for what our full-year outlook would be. And I'm at this juncture looking like that's very much on trajectory. We haven't seen any significant spike up in any particular sector, particularly in retail or in SME. There will be pockets and geographies which are affected by local events, but on balance, I don't see any sharp change at this juncture. On the corporate, which typically tends to be the swing factor, the universe that we had identified still holds. Mercifully, none of the new names that are cropping up every now and then we feature in any of them. So I think the universe is defined unless some sort of crazy event happens in the market. Our guidance for a full year pretty much looks like we will be able to honor those guidance through the financial year. Quarter I can't quite comment, but on a full year basis, yes, trend lines look reflective of what we've committed.
Some crazy events are happening. Look at the way the NBFCs are going, then housing finance companies, then loans against shares, and now auditor revelations in companies like CG Power, which one never expected. Mr. Mohapatra, similar question to you. Are you worried about either MSME or any other sector, NBFC or retail, because of the slowdown and liquidity issues?
Lata, what I have seen, first I will give my comments on the NBFC. What I have seen is all the mid-sized NBFCs, they were doing well in the past, they are doing well in now also. The stress level in those NBFC is much, much less because they are focused in particular segments. But those NBFCs which are very, very large, and they have exposure in different segments. So there is a stress because if any particular segment is getting hit on account of the market conditions, so the entire book of those NBFCs is getting hit. But this type of stress, to be very frank, I am not seeing in case of the mid-size NBFCs. This is on the NBFC. Now on the retail side, you asked the question to Mr. Shyam regarding the retail book, any stress. What we have seen is, because our major portfolio in the unsecured piece segment loan is basically against the salary and against the pension. And major portion of against the salary is mainly the government employees.
Sure.
So we are not seeing the stress in that particular book. And whatever is the stress in that book is much, much lower than the stress in any other segment. Regarding the MSME, though there is some stress, but with all the measures which have been taken by Reserve Bank of India, like I will quote that in January, then when they came out with the restructuring with only a provisioning of 5%. So a lot of MSMEs who are continuing with the activity, they are coming forward for the restructuring.
Okay.
And this is also helping the MSMEs as well as the banks for that.
So, Mr. Mohapatra, just one number if you can give us, what is the exposure that you have to DHFL as well as to the ADAG group?
Specific company exposure, normally as per our policy, we don't give.
Okay.
So that I will not be able to give, but it is less than some of the large exposures by other banks.